Hi. In today's video, we discuss the significance of fundamentals in swing trading and how you can quickly make a judgment of a company. As a swing trader, fundamentals are an often overlooked part of the trading toolkit. Traders find it either too boring or too exhausting due to the many variables to consider. However, adding basic fundamentals to your trading can not only help you narrow down the list of potential trades, but also increase your win rate and returns. The following chart provided by Stockopedia demonstrates its worth. The green line here represents the return from quality stocks showing momentum. The line, represented by the term QM, shows that the top stocks in the category outperformed all other categories and significantly beat the broader market with a return of 331%, versus just 24.6% of the FTSE All-Share Index over the same period. This variance in performance makes a strong case for combining momentum with quality to enhance your trading results, especially when it isn't too grueling to get fundamental data if you have the right resources to hand. So, let's first understand where the fundamentals should factor in the overall trading process. In my strategy, I look for momentum in the stock price first. My scanner, which I share in our group, scans all the major indexes across the globe and helps us segregate stocks that have the right technical structure while still showing momentum. To be more specific, the scanner looks for stocks breaking out of consolidation. Once we establish that the stocks we're looking at on the chart qualify, we then move to look at the fundamentals to shorten the list further. Fortunately, the scanner provides a score against technical, momentum, and fundamental values, and lists them with the best scores higher up the list. This takes a huge amount of time and effort away from the process. There can be several fundamental metrics to analyze to make a case about a trade. Going into all of them will only complicate the process. This is why we focus on the most basic and important metrics, screening for quality metrics within a company's financial statement. My simple fundamental criterion is to see double-digit percentages in return on capital, return on equity, and operating margin. Each of them have a significant weighting in the overall quality score seen in our software. If companies fit the criteria, I like those companies to also be showing sales and profit growth whilst having sensible debt. Let's briefly cover those metrics one by one. Return on capital, or ROC, is the percentage return a company makes on the total capital employed in the business, including owner's capital and debt. A double-digit ROC suggests that the company's business has a solid return profile. Return on equity, or ROE, is the percentage return the company makes on an owner's equity. Here also, a double-digit percentage means that the company is efficiently utilizing its capital and can generate decent returns on the investor's equity. I like these ratios to be in double digits, meaning we have higher than the risk-free return, i.e. the return on long-term secured government securities. The rationale is simple. When someone can earn a risk-free 5% on a long-term treasury security, a risky venture should yield much higher than the 5% offered for investors and lenders to take the risk. This is why the businesses that earn much higher returns on capital are often inviting for investors. Next, I like to see a double-digit number in operating margin. Operating margin is the margin the company earns from operations, which is sales less expenses incurred in direct operations. A double-digit operating margin simply says the company has a good business that delivers solid profits on each dollar of sales. Once the stock passes these filters, I like to see growth in revenues and profits. The last factor I look at is the indebtedness of the company. I prefer companies that have manageable levels of debt. By manageable, I mean that they should have enough earnings and cash flows to service the debt and pay it off when it gets due. A simple measure could be looking for companies with a debt-equity ratio of not more than 2x and debt-to-operating profit ratio of not more than 5x. Now let's get to the most important part, where to find these fundamental metrics in one place so that you don't get bogged down with data and statistics. To make it easy for me to glance through these fundamentals, our software allows us to look at the financial data in finer detail. Here it shows the return on capital, return on equity, and operating margin. You can also get a host of other metrics if you prefer. The top part of the screen shows the income metrics, including revenue, operating profit, and net profit, with their respective trends over the last 7 years. It also provides the earnings estimates for the next year, alongside the historical numbers. There is little doubt that fundamentals and growth are a major factor behind stock prices. The change in fundamentals can be tangible, like earnings growth, or intangible, like a sudden change in sentiment. As a trader, if you're aware of these changes, you can be much more confident with your trades and improve your returns significantly. By combining fundamental and technical data together, you can build a very potent strategy indeed. And with software such as ours, it does not need to be a laborious process. I often show my equity chart through our videos, not to gloat or any other agenda, but to simply show what is possible when you have the right resources and the right mentality. As always, thanks for watching.